If you own a home or rent one right now, something has been quietly happening in the background, and most people are completely unaware of it. 5 significant rule changes have either already gone into effect or are actively being rolled out across the country right now. And they affect homeowners, renters, landlords, condo owners, and retirees living on fixed incomes. And the part that really bothers me about all of this is that these changes aren't getting the attention they deserve. They're not on the front page of your newspaper. They're buried in municipal code updates, in federal mortgage guidelines, in state legislature sessions that most people never follow. But the impact? The impact lands right on your doorstep, sometimes literally. So today, we are going to fix that. By the time this video is done, you're going to understand what has changed, why it matters for your specific situation, and what steps you can take right now to protect yourself. And I will tell you, number 5 on this list caught me completely off guard, and I think it's going to surprise you too. Stay with me. I'm Linda, and welcome back to Retires with Linda, the channel where we talk about real money, real housing decisions, and real life planning for people who are in or approaching retirement. We don't do fluff here. We don't do click and forget videos. Everything we talk about on this channel is something that could genuinely affect your finances or your quality of life, and today is no exception. If you're new here and this is your first time watching, I want to make you a promise. Subscribe to this channel right now, and you will never walk into an important financial or housing decision uninformed again. Hit that subscribe button, turn on the bell for notifications, and let's get into these 5 changes. Let's start at the ground level, literally, with something that is hitting older homeowners in a very unexpected way. Across dozens of cities and counties around the country, local governments have been strengthening and, in some cases, completely overhauling their rules around accessory dwelling units, which are the extra living spaces on your property. Things like a basement apartment, an in-law suite, a converted garage unit, or a separate guest cottage. For years, a lot of homeowners, especially retirees trying to supplement their income, have been renting out these spaces on a fairly informal basis. A handshake agreement, a simple lease, maybe nothing more than a verbal arrangement with a trusted tenant. And in many neighborhoods, that was fine for a long time. Nobody came knocking. That is changing. Municipalities across the country are now enforcing inspection and permitting requirements for these spaces more aggressively than at any point in recent memory. And we're not talking about a gentle reminder letter. We're talking about fines. In some jurisdictions, operating an unpermitted rental unit, even a small basement room, can result in fines that start at several $100s and escalate to several thousand if the issue isn't resolved. And here's where it gets really complicated. Even if you want to get the space permitted properly, you now have to pass a formal inspection. And the standards have been updated in many areas to reflect newer building codes around things like ceiling heights, emergency egress windows, smoke and carbon monoxide detector placement, ventilation requirements, and electrical safety. For a basement that was finished 15 or 20 years ago, it's entirely possible that getting it up to current code would require actual renovation work, which costs money. Which means the rental income you've been counting on could be interrupted for months or indefinitely if the renovation costs aren't feasible. If you have a rental space on your property and you haven't verified recently that it's compliant with your local rules, this is your sign to do that. Pull up your city or county housing department's website. Look for their rules on accessory dwelling units or rental housing inspections and find out where you stand. It is far better to find out now, on your own terms, than to have a neighbor file a complaint and get a notice in the mail. The other thing worth knowing is that some of these same municipalities are offering amnesty programs or streamlined permitting pathways for existing informal units, so there may be a way to get compliant without the full gauntlet of standard permitting. But you will not know about those options unless you go looking. And I want to add something here for the folks who are renting out that space because they need the income, which is genuinely a lot of retirees and near retirees across the country. If the regulations in your area make it difficult to continue renting informally, it might actually be worth the investment to go through the proper permitting process. In many markets, a properly permitted and legal accessory dwelling unit adds value to your property, both in terms of what you can charge for rent and in terms of what the property is worth when you eventually sell. The short-term pain of getting compliant can have a real long-term payoff. Just make sure you understand exactly what compliance requires in your specific city before you commit to anything. The second change I want to talk about is one that affects condo owners specifically, and it's something that genuinely could affect your ability to sell your home when you're ready. After the Champlain Towers South collapse in Surfside, Florida in 2021, a tragedy that claimed 98 lives there, was a major re-examination of how condo buildings across the country are maintained, inspected, and financed. The result, at the federal mortgage level, is that Fannie Mae and Freddie Mac, the two government-sponsored entities that back the vast majority of home loans in the United States, changed their lending guidelines for condominium buildings. Here's what those changes look like in practice. When someone tries to buy a condo unit in a building, their lender now has to review the building's financials and physical condition before approving the loan. Specifically, they're looking at whether the Homeowners Association has adequate financial reserves, meaning money set aside for major repairs and replacements. Things like roofing, elevators, plumbing systems, structural elements. They're also looking for any outstanding inspection reports that flag critical or significant deficiencies in the building's structure. If a building's HOA reserves are significantly underfunded, and a shocking number of HOAs across the country are, or if there's a flagged structural issue in a recent inspection report, Fannie Mae and Freddie Mac may classify that building as ineligible for conventional financing. And if buyers can't get conventional financing, the pool of potential buyers for your unit shrinks dramatically. In some cases, it shrinks to essentially zero because the only buyers left are all cash buyers who know they have all the leverage and will offer accordingly. This has already played out in real ways in Florida, California, Illinois, and other states. Condo owners who had no idea anything was wrong have put their unit on the market and found out only after offers start falling through that their building is on a restricted or ineligible list. If you own a condo, I want you to do one thing this week. Ask your HOA board or property management company for the most recent reserve study and the most recent structural inspection report. You have a legal right to those documents as a unit owner in virtually every state. Look at those numbers. If the reserves are underfunded or if there are known issues being deferred, this is information you need, both so you understand the financial exposure of your building and so you have time to push for action before you're ready to sell. And here's something else worth knowing. If your building is flagged and financing becomes difficult, it doesn't just hurt sellers, it hurts every owner in the building. Because comparable sales in the same building that close at distressed prices or cash discounts pull your unit's market value down too. It's a shared problem that requires a collective solution through your HOA. And that starts with knowing the facts. Don't assume your property management company is on top of this. Verify it yourself. Ask directly. Get it in writing. And if the answers you get raise red flags, you may want to talk to a real estate attorney who specializes in condominium law in your state. Because in some situations, unit owners do have legal options when an HOA has been mismanaging reserves or ignoring required inspections. Now let's talk about something that renters need to hear, because this third change is significant, and it cuts in more than one direction depending on your situation. Several states over the past couple of years have passed what are called just cause eviction laws, and others are moving through the legislative process right now. Under a just cause eviction law, a landlord cannot simply decline to renew a lease when it expires. In the traditional model, when your one-year lease ended, your landlord could simply say, "We're not renewing, you have 30 days, and that was that," regardless of whether you'd been a perfect tenant for 10 years. No explanation required. Under just cause eviction laws, that's no longer allowed. A landlord must have a specific, legally recognized reason to remove a tenant. And "I want a new tenant" or "I want to increase the rent" are not on the list of accepted reasons. The accepted reasons typically include things like non-payment of rent, substantial lease violations, nuisance behavior that affects other tenants, or the landlord genuinely needing to move back into the property for personal occupancy. And here's a nuance that most people aren't aware of, even in those allowable cases. Many of these laws now require the landlord to pay the departing tenant relocation assistance. Depending on the jurisdiction, that could be 1 month's rent, 2 months, or even more. In a high-cost city, that's potentially thousands of dollars the landlord must pay out of pocket before a tenant leaves. For renters, especially older renters on fixed incomes who have found a home they love and cannot afford to be disrupted, these laws can provide genuine peace of mind. But there's a flip side. Because of these increased requirements and the financial risk they create for small landlords, some property owners have decided to exit the rental market altogether. They're selling their rental properties rather than navigating the new regulatory environment. And in some neighborhoods, that means fewer rental units available, which puts upward pressure on rents for everything that remains. It's a dynamic worth understanding because it affects supply and demand in ways that eventually touch everyone. Whatever your situation, whether you rent or you own rental property, know your state's current law. These rules vary significantly by location, and they've been moving quickly. A quick search for your state name and just cause eviction law will tell you where things currently stand. If you're a landlord and you're not sure whether the new rules apply to you, don't guess. Reach out to a local real estate attorney or a property management professional who works in your area. The cost of a 1-hour consultation is almost always less than the cost of getting it wrong. The fourth change is one that affects renters across the board. And honestly, it's one that I think most tenants have experienced without necessarily having a name for it. If you've rented in the past few years, you've probably noticed that the monthly cost of renting a unit goes well beyond the number on the listing. There's an administrative fee, a building amenity fee, a mandatory renter's insurance enrollment, a package locker fee, a trash service fee that's somehow separate from rent, a pest control charge. These fees have proliferated at a remarkable rate, especially with the rise of large corporate property management companies that have developed entire revenue strategies around supplemental charges. The advertised rent is the entry price, and then the actual cost you pay every month can be meaningfully higher. Federal regulators, including the Consumer Financial Protection Bureau, have been drawing significant attention to these practices in the rental housing market, following a broader government push to crack down on what have been labeled junk fees across industries. And at the state and local level, several jurisdictions have started issuing guidance and, in some cases, formal rules requiring that all mandatory fees be included in the advertised rental price. The standard being applied is that a prospective tenant should be able to look at a listing and know what they'll actually pay every month, not discover an additional $200 in required fees after they've already signed a lease. Enforcement is still inconsistent, but the direction is clear, and renters now in many places have standing to push back on fees that weren't clearly and fully disclosed before signing. If you're currently paying fees that were not disclosed at the time you agreed to your lease, it may be worth a conversation with a tenants' rights organization or a local housing attorney to understand whether you have any recourse. And if you're shopping for a new rental, ask the landlord or property manager directly what is the total monthly cost, including all mandatory fees, before you sign anything. Okay, we've made it to number 5, and I told you at the start that this one caught me off guard. It involves property taxes specifically, the exemptions and caps that have protected long-term homeowners and retirees from being priced out of their own homes by rising assessments. Here's the background. For decades, many states have had rules that limited how fast a home's assessed value could increase, regardless of what the market was doing. California's Proposition 13 is the most famous version of this. It limited annual assessment increases to 2%, which, for longtime homeowners, meant their property tax bills stayed manageable, even as surrounding home values tripled. Numerous other states have had similar caps or freeze programs specifically designed for seniors and low-income homeowners. The idea was straightforward. If you bought your home years ago on a fixed income or a middle-class salary, you shouldn't lose your home just because the real estate market got expensive around you. What's happening now is that local governments, facing budget pressures and looking at years of flat or limited property tax revenue while home values have soared, are revisiting these protections. In several states, there are active legislative efforts to either raise the rate at which assessments can increase, reduce the income thresholds for senior exemption programs, meaning some seniors who previously qualified would no longer qualify, or both. And in some cases, these aren't future proposals. They've already passed, and the changes take effect on the next round of tax assessments. The reason this matters so much is timing. If you're retired and living on Social Security and a modest savings account, a property tax bill that increases by even $150 or $200 a month can genuinely upend your budget. It doesn't sound like a lot when you say it out loud, but when your income is fixed and your costs all trend upward, there is no comfortable margin to absorb it. And unlike some financial surprises, property tax increases don't announce themselves far in advance. You find out when the bill arrives. So here's what you need to do, and this is actionable. I want you to actually do this. Go to your county assessor's website or call their office and find out two things. First, are you currently enrolled in every property tax exemption or relief program that you qualify for? In most states, senior exemptions, homestead exemptions, and income-based tax freeze programs are not applied automatically. You have to apply for them. And a lot of people who qualify have never applied because they didn't know the programs existed. Second, find out whether any of those programs are changing in your state. Ask specifically whether income thresholds or benefit amounts have been adjusted recently. A quick conversation with your county assessor's office can give you that information for free, and it could be worth hundreds of dollars a year or more to know. I also want to flag something that often gets overlooked in this conversation. Some homeowners have successfully appealed their property tax assessments when they believe the assessed value is too high and won. It's a process that varies by state and county, but in many jurisdictions, you have a formal right to challenge your assessment. And if you can show that your home's value has been overestimated, you may be able to get the assessment lowered. Local tax attorneys or property tax appeal specialists can help you navigate that process, and many work on a contingency basis, meaning you pay nothing if your appeal doesn't succeed. If your assessment jumps significantly in the last reassessment cycle, especially if you haven't made major improvements to the property, it may be worth looking into. All right, let's take a breath and bring this all together, because we covered a lot of ground today, and I want to make sure it all lands. 5 real changes. Inspection and permitting requirements for rental units on your property are being enforced more aggressively, and the cost of non-compliance has gone up. Condo financing guidelines from Fannie Mae and Freddie Mac have changed in ways that can trap owners who can't sell because buyers can't get approved loans. Just cause eviction laws have expanded in multiple states, reshaping the balance of power between landlords and tenants in significant ways. Junk fee crackdowns at the federal and state level are creating new protections for renters and new compliance requirements for landlords. And property tax protections that long-term homeowners and retirees have relied on are under pressure in a number of states, with some changes already in effect. None of these are hypothetical. These are things playing out in real communities across the country right now, affecting real families. People who are retired, people who are close to retiring, people who thought they had their housing situation figured out. And the common thread across all 5 is the same. The people who know about these changes in time can make a plan. The people who find out after the fact just absorb the damage. That's the whole reason this channel exists, because information, the right information, explained clearly, before it hits you, is one of the most powerful financial tools there is. You can't always control what the rules are, but you can control whether you know about them. I want to leave you with one last thought before we wrap up. Housing is not just a financial asset. For most people, especially in retirement, it is the foundation of daily life. It's where you feel safe. It's where you've built memories. It's where you planned to age in place, or leave something to your family, or fund the next chapter of your life when the time comes. Changes to the rules around housing don't just affect your net worth. They affect your peace of mind, your sense of stability, and your ability to make decisions on your own terms. That's why staying informed about this stuff isn't optional. It's part of taking care of yourself and your family. Now I want to hear from you. In the comments below, tell me which one of these 5 changes hit closest to home for you. Are you a condo owner worried about financing? A renter dealing with undisclosed fees? A retiree watching your property tax exemption? Drop it below. I read every single comment, and your responses genuinely shape what we cover next. This is a community, not a broadcast. And if this video helped you today, please share it with someone who needs to hear it. Your neighbor who owns a rental unit, your sister who's renting an apartment, your parents who've been in the same house for 30 years and think their property taxes are locked in forever. One share from you could save someone a lot of money and a lot of stress. That's not an exaggeration, so please pass it along. Thank you for being here. Thank you for watching all the way through. And honestly, thank you for caring enough about your own situation to seek out this kind of information. A lot of people don't do that. A lot of people wait until something goes wrong and then scramble to figure out what happened. You're not doing that. You're here, you're learning, and you're going to be better prepared because of it. Subscribe if you haven't yet, and I will see you in the very next video. Take good care.